Welcome to Real Estate Economics webinar series. Real Estate Economics is a leading provider of residential market consulting services and online research tools. We provide periodic webinars covering a variety of topics of interest to the home building, land development, and lending industries. I'm John Mulville, Vice President of Consulting here at Real Estate Economics, and I'll be presenting this week's webinar on Seattle, Washington. Let's start with a historical look back to June 2006. We picked this date because it was before the time the current market disruption really took hold. At this point in time, the national economy and the Seattle economy was performing quite well. Mortgage loans were readily available. Consumer confidence was quite high. You can see at that point in time, new home sales were about 18.7% of all sales in this market. We would consider that a pretty robust number. Normally, on a long-term historical basis, we'd expect new home sales or new construction to represent about 10 to maybe 15% of the total market share. So builders were having a good time here at this point. Foreclosures and foreclosure sales are a very small part of the market, and conventional resales, that's owner to owner of existing homes, was 78%. So market demand was sending quite a few buyers into the new home offices, and that part of the market is performing quite well. Let's come forward 5 years to today, and you can see what a change in character we've had over the past 5 years. At this point in time, foreclosure sales, that's lender to a new third-party owner, are about 20.5% of transactions. Foreclosure sales, that's owner back to lender, almost 20% at 19.8%. New builder sales, 8.3%. That's actually a fairly decent number if you look across the nation. Most markets regionally aren't performing at that level. And conventional sales, this is a category that tends to include short sales, are about 51.4% of all the volume. Let's look at the price action over the last 3 years. This is May over May, 2011, 2010, 2009. If you recall, 2010 we had the federal credits. That put quite a bit of interest into the market through the first half of 2010. We thought that in many markets where you're active in, the end of 2010 was our trough in sales. We believe that the tax credits brought quite a few buyers into the market in the middle of 2010 and drew demand out of the back half of 2010. The other thing that's already being forgotten is we were looking at a federal income tax scheduled to go into effect at the end of 2010, and that led to a lot of cautious consumer behavior. And really the slowest sales we've seen across many of our markets took place in the fourth quarter of 2010. 2011 has started out slow in some areas, acceptable in other areas, but we've still got a little bit of drawdown in terms of value ratios, down to $212 per square foot, and also in terms of price in this market, down from $380 a year ago to $340 at present. Let's look at the transaction volume by type of sale. The blue are the conventional resales. Again, that's a category that can include short sales. The green is new builder sales. The red is foreclosures. That's owner back to lender. And the burgundy is foreclosure sales. That's lender out to new third-party owners. We've seen quite a few lenders begin to approve more short sales and do less repossessions of homes. It's much quicker, more expedient to accept a short sale than it is to take possession of a sale and remarket it. Simply having somebody in the unit, even if they're unhappy or about to leave owners, they'll tend to water the grass and flush the toilet, and so the home gets much better care, even if those people are leaving soon, than if it's vacant and available for vandalism and squatters and that sort of thing. So we've seen quite a pickup in most markets in conventional resales. New home sales continue to trend lower here. Foreclosures and foreclosure sales are both up significantly over last year. We're starting to see an improved ability of many lenders to deal with their foreclosures, although foreclosure times tend to be quite long across the country. We think that lenders are gradually positioning themselves to improve their processes and their pipeline procedures, and so they will be able to turn their distressed inventory out a little bit quicker than they have in the last year or two or three. Let's look at distressed housing in this particular market area. The tall bars, blue, are notices of default. The red bars are foreclosures, and the green bars are foreclosure sales. A couple of points here. The foreclosure sales have been exceeding foreclosures in the last few periods and are expected to do so for several years. That gradually works down shadow inventory and lender inventory. As slow as the lenders have been the last couple of years, this process is likely to draw out a couple of more years and just have a slow resolution overall. Between robo-signing and the different things that have taken place in the foreclosure market, it's clear that the lenders still own quite a few units in many, many markets. Lender performance has been very uneven. We have markets where the lenders are doing great in one area. They're getting out a lot of inventory. The realtors in those areas are sometimes happy because they have good buyers for those, rental investors in many cases. And we have other areas where there's frankly too much foreclosed inventory and it's weighing on prices. So it's very much a market by market situation. Let's look at distressed housing trends and forecasts. Here's our these are annual numbers, 5-year forecast plus some historical. We saw a buildup here in terms of distressed housing and a gradual drawdown. Now, I'd almost anticipate that this drawdown goes on a little bit farther. It might just be our current perspective that lenders have been very slow and that people report not making their mortgage payment and not getting a call from their lender for 12 months, 24 months, 36 months. So there's quite a few issues here. It's clear that banks own quite a few homes and that these are gradually going to come out to market over time. Just how much time is the question today. We know staffing levels have come way up at most of the major institutional lenders, and we would expect over time, as some of the documentation problems solve themselves, that these banks will be better prepared to distribute some of this inventory. Let's look at housing supply in this market. You can see our current levels, 2011, just barely under 6,000 new units. That's the lowest we've had in this whole survey period going back to 1991. If you think about this, the market is really prepared to provide fewer new homes in 2011 than in 1991, when the employment numbers were about 30% smaller than they are today. So we're adding population in this area. As we'll show in coming slides, we're adding workers gradually in this area, but we're not adding housing supply in any big numbers. If you start to think that some of this supply is coming in multifamily or apartment construction, given rental rates and improved demand for rentals, there's relatively few new detached single-family homes in this area, and that's a characteristic that we see across many markets of the West. If we aggregate new home supply with shadow inventory, you can see that the shadow inventory actually kept the total inventory up to semi-normal levels during 2010, somewhat during 2011. But in the next several years, shadow inventory will become a smaller and smaller part of the whole overall market activity, and new construction will have to fill that gap and meet the pent-up demand that's being created by years and years of population growth, eventual employment growth, but very, very little new construction. Let's look at employment in this market area. This is a very similar situation to what we see in many markets across the West. If you look at the total employment in year 2000, just slightly under 1.4 million. Come forward all the way to 2011, and we're just about at the same number, 1.4 million. We've got many markets across the West where job growth has been soft to stagnant on a decade or longer basis, really preventing the housing market from rebounding robustly and performing anywhere near it would the levels that it would if we had higher employment. Now it looks like here in the next few years we're going to be picking up some employment, and that should help us out with housing demand. But this same sort of soft job growth isn't just a phenomenon that we've been experiencing in the last 2 or 3 years, but many large MSAs across the West haven't really performed that great in terms of employment on a decade or generational basis. This is also true across the country. We have many, many markets, Chicago, Detroit, some of the Rust Belt areas, that are suffering tremendous job losses, while there's huge migration to the south, to Texas, and a number of other states where employers can find friendly labor law conditions. Let's look at the 12-month job change. As you can see, this market suffered a little bit of a drawdown in 2001 and 2002 during the dot-com bubble burst. Experienced a rebound during the subprime when a lot of jobs come into construction and related industries, and then the most recent recession really taking the job counts down severely in 2009. 2010, although it didn't feel like it, was a year of some gradual improvement and stabilization, and now this market area is on the cusp of some improved growth. We can see this in many markets nationally. We're not really getting impressive numbers, but market to market, region to region, there are areas that are performing reasonably well, showing a stronger foundation, and those will be the markets where there's good opportunities for builders. Let's look at the 12-month job change. This is 2010, April of 2010 to April of 2011. We'll show a year ago in the next slide so you can tell the character change that's occurred in employment in this particular area. We're still losing jobs in government. That's been a typical theme across the nation. Many states benefited, and municipalities benefited tremendously from the American Recovery and Reinvestment Act. That ended on June 30th, synced up perfectly with QE2, so many states that were receiving, and municipalities that were receiving federal support for the last several years, are not going to be receiving that support going forward. That's going to put a lot of pressure on state and local budgets that are really just starting to manifest themselves. If you see the current news, you know, the news goes from state to state and municipality to municipality. There are many areas dealing with severe or worse budget problems, and that's a theme that we'll probably see play out for the next several years. Government aside, construction remains weak, but all other sectors seem to be performing pretty well. Business and professional service, a lot of that is consulting, self-employed small businesses that are supporting the main industries in any of these different MSAs. Trade, transportation, and utilities have bounced back, and so has manufacturing. Manufacturing is a tremendously overlooked area of growth nationally and in this market area. The U.S. has had a tremendous boom in manufacturing construction in the last year or two as the dollar has depreciated. It hasn't been large enough yet to overcome job losses in other areas, but it's definitely a source of growth as we sit here in 2011. Compare that to the character of the job market a year ago. There were job losses across nearly every category. Manufacturing obviously severely impacted in 2009 and 2010. Construction grinds to a halt. Trade, transportation, a lot of job losses there. And then financial activities. There's probably some job losses still coming in financial activities as we come forward, but we'll have to see how that plays out. Government was already feeling some downsizing in this area, as many municipalities, they left jobs open and didn't do rehiring in some places, sensing that they were going to have budget pressures in the next year or two. Let's look at the 12-month change here, slightly different format than we showed in the bar graph a moment ago. Drawdown here during the dot-com bubble burst in 01, 02, 03, a nice rebound, much of it construction related during the subprime bubble, only to experience huge job losses in 2009 and significant additional losses in 2010. Now we're at the point in time where we're going to see building improvement, steadying improvement, and some growth over the next 4 or 5 years. It's going to take a couple of years to recapture that 100,000 plus number of losses that we experienced from 2009 to 2010 in this market. But gradually, those will take hold, and that'll put some support under the housing market. Let's look at housing demand and supply in this area. The supply of housing, we talked to a little bit earlier, how the supply levels were very, very low. If you think of housing supply in any market, it tends to grow very slowly. The permitting process, finding land, designing a product, getting the approvals and entitlements and all that sort of thing that you merchant builders know goes with bringing any new community to market, is inherently a slow process, and so supply tends to grow quite slowly in almost all conditions. By comparison, the demand for housing oscillates tremendously as it's tied to employment growth. During periods when jobs grow very quickly, the demand for housing can quickly outstrip the supply growth, leading, of course, to higher prices, price pressures. You can see the run-up to the subprime era in January of 2000. That whole time period, as the market ramped up for that, job growth was very good, and so demand outstripped supply, really peaking in about 2001. We saw the trend down as much of the subprime employment, or not the subprime, the dot-com employment withered into 2002 and 2003, a rebound into 2006 and 7, and then the most recent market disruption, where we fell off from about 1.15 million homes demanded all the way down to about 1.05 million homes. That's 100,000 housing demand change just in the period of about 2 years. Now, what causes that? When people lose those jobs, there is not that demand for housing, and suddenly it creates a situation where the housing stock is too large for the employment base. And until that employment base grows back into the housing stock, which doesn't change that much, sellers will be under pressure, prices will be under pressure, and it's going to take a couple of years until equilibrium is reached again. If you look at where we're at today, in the beginning of 2011, the green demand for housing is far below the supply. That's a period of undervaluation. That means there's more homes out there, and the prices are lower. So it's a good opportunity again in terms of prices that we'll show in an upcoming slide. Here we can show that over and under supply numerically. We had significant undersupply, as I mentioned, going into the dot-com, only to face a little rebound. Then we got a subprime bump in 07 and 08. Then the most recent market disruption, taking us down to an overbuilt situation of about 90,000 units as of January of 2010. This was facing about a 5-year improvement or total cycle back to equilibrium. With about 2014 or 2015, we'll be seeing some generalized equilibrium. Here again, where the market will be not really overbought or not really underbought. And then later in this forecast period, this market again will be underbuilt as the industry is really no longer able to provide housing in the numbers that this area will need. If we get any sort of stronger economic ramp up in the next few years, the underbuilt condition could be more severe than what we're forecasting here. Let's look at housing valuation for this particular market area. Under most circumstances, prices and supportable prices are pretty closely aligned, because for years and years you had to qualify for a loan. There was an underwriting process. They looked at your income. They decided what your expenses were, how much free cash flow could you contribute to a mortgage payment. That all worked out fine until we threw the underwriting book out the window. In about 2005, subprime kicked in, and suddenly you could get a loan much larger than you were capable of paying back. There's only one way for that excess loan sizes and that excess liquidity to play out, and that was through much higher prices. So you can see the spike in prices here, 2005, 6, 7, 8, and now the payback period comes in 2008 with a big drawdown in prices that continues right up to about 2011, where we're troughing out here and getting a little bit of improvement over the 5-year forecast. Now here, the green line and the blue line, that spread between those two, that's again a manifestation of undervaluation. So as we begin to pick up jobs, the undervaluation that currently exists in this area will gradually shrink down. Also, if you notice the green line, that's the supportable median home price. That comes down over the next 4 or 5 years as higher rates put a little bit of a lid on appreciation here. We'll get to unwind the undervaluation, but then we don't have a real severe run-up in prices in this market over the next 4 or 5 years, just because higher rates are going to make it harder and harder for people to move aggressively up the price ladder. Here we can see that another way. The deep overvaluation that took place during the middle of subprime. Most of those people now are getting flushed out. As long as it's been taking the lenders, we're still only partway through that process. And now we're in a period of tremendous undervaluation. Well, many people say, if things are so undervalued, how come the market isn't recognizing that and everyone's out buying houses? In a way, they have. We have rental investors active in a lot of these market areas. They're swooping down and picking up, the best of the best, and immediately turning around, renting those homes out, putting those back in the market for rentals for the next 4, 5, 10 years until prices improve. We also have seen a propensity for older individuals, older households who've seen a couple housing cycles to be more active in the market than younger households who haven't experienced housing market volatility in their lifetimes. This particular table shows median home prices for this market area. A good run-up in the dot-com period, another even larger and less sustainable run-up during subprime, and then again the large losses that we experienced in 2008, 2009. Those continued into 2010 with a soft initial part of 2011. As there are fewer and fewer foreclosures in this median home sales data, we'll start to see some appreciation, maybe not caused as much by significantly stronger economic fundamentals, but as we burn through the distressed inventory, as the foreclosures draw down, those sales will make up a smaller and smaller portion of the overall transaction count, and that will lead to an improvement in values with or without a huge improvement in the economy. Here we can look at median historical home prices. Naturally, we have the huge run-up like we saw in the previous slide on overvaluation and undervaluation. A huge trough in 2007, drawing back all the way to about 2005 prices, I would say. Maybe 2006 prices are about equal to 2011 prices. You saw we had some appreciation in our last forecast, so over the next couple of years we'll get a gradual run-up supported by improvements in hiring, improvements in the employment base, but restrained, if you will, by higher interest rates. There we can see the line. So by, let's see, 2015 we'll be back to about 2008 levels, but still below the peak that we saw at the apex of the subprime problem. Now here's our residential opportunity and risk report. This area, I like to split this up left side to right side, and if you'll pay attention with me for just a minute on the overbuilt and underbuilt on the left side of the screen, we will characterize this market as being overbuilt or underbuilt based on employment conditions. When the job base shrinks very quickly, as it does during a recession, as it has during the last couple of years during our economic and financial market difficulties, employment declines, and as I mentioned earlier, the housing stock seems too large for the employment base. That produces a situation where the market is characterized as being overbuilt. Now, as I mentioned earlier, we haven't really built that many homes in this market, so it's not hugely a function of construction, subdivisions going up everywhere. Certainly there's pockets where building levels were high, But most of this overbuilt condition is a function of the tremendous job losses we've suffered here and in many other markets across the West. Now, as the employment market improves, this condition will gradually dissipate and overbuilt will transition into a equilibrium condition in about 2014 and then be slightly underbuilt in the out years of the forecast in 2015 and 2016. Let me switch directions and come to the right side, where the market is characterized as being overvalued or undervalued. In all the market areas we study, we know what the median household income is, we know what the mortgage rates are, and we know historically what portion of the household income people have been willing to contribute to their house payment. So we know what a medium supportable house price ought to look like. Equilibrium home price is right down the middle. Now, right now, we know that people have historically been willing to contribute more to their house payments than they are presently, and since the median home price is far below that equilibrium home price, the market can be characterized as undervalued. In fact, at this point in time, it's significantly undervalued. Now you can see over time, that'll gradually correct once we get an improvement in economic sentiment, once the employment base starts to rebuild a little bit, once there's more encouraging news out there, people will adopt a less cautious stance about consumer spending and begin to reconsider home purchases. So you can see over time, this undervaluation dissipates. It takes a couple of years. It's a multi-year process, and gradually in the out years, 2015 and 2016, this market will reach equilibrium and then switch again, where people will be paying up, if you will, for the opportunity to buy a home in much better economic conditions. Right down in the middle, you can see our annual price change, negative 1.2 for this year, 2011, but showing modest improvement and accelerating improvement over the next couple of years. That's our overview for Seattle today. I'm John Mulville. If you have any questions about today's presentation or any market area that you might be active in, feel free to give me a call, 949-502-5151. I'm at extension 102. Thank you for joining us today.